Hi folks, Chuck Gibson from Financial Perspectives with December 2017's Charts on the Move. In the past years, I typically spend all of December's video looking back at the year in retrospect. But because this year's look back can easily be described in two simple words, bull market, I thought just a quick recap would be sufficient. The remainder of the video will be spent laying out my expectations for 2018. I'm not talking about making the useless, crazy, but fun predictions I've done in the past, but instead focus on some key market influencers using evidence-based analysis to formulate a thesis for the next year. Before we go there, let's take a look at 2017's returns. As you can see in my first chart, it was a good year for risk assets. Almost everything but a few commodities, short-term US bonds, and volatility had a positive year. But not all commodities took it on the chin, as the three biggest winners, palladium, lumber, and copper in 2017, are all commodities. Interestingly, and in case it's not obvious, these three are all important inflation-related proxies. Looking at returns from our more widely investable assets, almost every category had double-digit returns, and many stock indexes gained 20% or more. Looking across the aisle at bonds, as you would expect with investors in full risk-on mode, they struggled as the U.S. aggregate index turned in a 3.5% return, while the global bond index could only eke out 2.8%. A global portfolio consisting of 50% stocks and 50% bonds gained an excellent 12.2% for the year. Before I move on to building a case for what to expect in 2018, I realize I utilize a lot of charts to help illustrate my stories. It's important to know not everyone sees the same thing when looking at them. This chart here can be viewed as a duck, but turn it around and it's a rabbit. Chart reading's an art, and the more you do it, the more you see and the clearer the message becomes. But when you do it as long as I have, they can take on a very different perspective. So if you find yourself struggling with following along, don't feel bad, as you're not alone. With 2017 being the barn burner year that it was for risk assets, one might guess that next year's returns are going to be poor, meaning the next year's returns depend upon what happened in the prior year. A large gain should likely be followed by a smaller gain, or a fall in 1 year might more likely be followed by a rebound higher. As it turns out, it doesn't seem to matter, as you can see in my next chart. Data over the past 120 years shows that whatever happens in 1 year has very little impact on returns or probabilities in the following year. If stocks gain over 20%, their return the next year is not much different than if the market had fallen. Moreover, the odds of stocks rising next year is the same regardless. If you're wondering why, it's because of stocks' natural long-term upward bias. How about the fact that stocks are so expensive? This has to be a headwind, and as such, we should expect poor returns next year, right? As it turns out, valuations have little predictive value on next year's return, as you can see in my next chart. The correlation coefficient between the two is just 10%, meaning 90% of next year's return is explained by factors other than valuation, as is detailed in this 1-year returns chart here on the left. So, while current valuations are high by almost any measure I use, and something that concerns me massively, valuations have historically had little impact on how stocks fared in the following year. Notice I said the following year, because looking out further, that's definitely not the case, as is clear in the 5-year returns chart on the right. You can see the plots become tighter, the correlation becomes stronger, and the higher the PE valuations on the bottom, the lower the forward 5-year return. Bull markets usually end with a period of investor exuberance, during which time valuations spike higher than we can imagine. Based upon where we sit today, as compared to historical levels, we still have room to move higher if the market wants to continue its run. Whether this occurs in 2018 or beyond is anyone's guess. Regardless, investors should reset their expectations that annual gains will likely be much lower over the coming years. Another concern with today's investment environment is that the rising rates could derail the stock market. The Federal Reserve has raised its guidance rate 5 times since December 2015, and based upon their outline, it is expected they will continue raising them throughout 2018. But historically, equity prices usually rise with rates. Why? Because rising rates imply continued economic growth. Better incomes lead to more consumption, which eventually leads to increased investment. Higher tax revenues also allow the government sector to spend. This is a virtuous cycle that raises corporate profits, consumer confidence, and the stock market. In fact, in the past 70 years, as you can see in my next chart, there have been 12 discrete tightening periods, during which the S&P has risen 83% of the time by a mean of 9 to 10% per annum. The only two losing periods include the 1973 oil embargo and the 1987 crash. The bottom line here is that so long as the pace of the rate increases and the actual increase is moderate, unlike 1966, higher interest rates should not be a negative factor, at least in 2018. Let's look at the presidential cycle. 2018 is the second year of this 4-year cycle. As you can see in my next chart, these years have had lower returns than other years, gaining on average 4% versus 7% for all years. The theory behind the cycle is that the presidents goose the economy into each election, and year 2 is thus the cycle low point between these efforts. However, as the chart title above notes, year 2's lower return is not statistically significant. That is easily seen when looking at the past 9 cycles. Year 2's have varied between a gain of 27% and a loss of 23%. Separating first terms from second terms doesn't improve the fit any better. The bottom line is there is just too much variability to rely upon this cycle given an investment edge in 2018. Should you be tempted to believe that the years ending in the number 8 imply a probabilistic outcome, keep in mind that years 5 were supposed to be the best year of any in the decade, yet 2015 closed down 1%. Taking a look at sentiment, after an 8-year bull market and a 26% return in the past 13 months, it should surprise no one that investors are now leaning bullish. But the fact is, data on sentiment is mixed. Options data and Investors Intelligence Survey, which are the newsletter writers, suggest investors are very bullish. Yet AAII, which are the retail investors, and fund managers surveyed are sitting neutral. Drilling down and looking at fund flow data, it indicates that investors in the U.S. are not at all bullish, as you can see in my next chart. Domestic equity ETFs and mutual funds have had outflows for 8 months in a row. This is not the typical behavior of an indiscriminate bull market. Looking at past equity peaks, both 2000 and 2007 were accompanied by persistent equity inflows, a situation very unlike today's, as equities have experienced outflows in 7 of the past 10 quarters. With sentiment data so mixed, let's assume for the moment that the Investors Intelligence Survey is the most accurate measurement of current sentiment. Bulls have outnumbered bears in this survey by more than 4 to 1 since the start of October. The conventional wisdom is that stocks should decline under these circumstances. Instead, the S&P has gained nearly 5%. Interestingly, that result is not an outlier. Over the past 48 years, when these same investors have been very bullish like now, the S&P has risen further in the next year, 71% of the time, by an average of 7%. As you would expect, the best returns occur in the year after investors have been bearish, as gains are 2.5 times higher. This data helps support why moving opposite to the crowd is usually the most profitable. Turning our attention to earnings, the annual growth in earnings over the past 7 years has been 6%. 6% earnings growth is roughly in line with the economic and consumption growth of 4.5% in the U.S. In the past 3 years, the price of oil and the value of the dollar have had a material impact on corporate profits. Right now, these appear to be tailwinds for earnings in 2018, but their variability means making a more exact growth forecast is difficult and prone to error. The big wildcard right now with respect to earnings is the corporate tax cuts. Analysts estimate that this could add $10 to next year's earnings, meaning earnings growth could jump from 6% to 13%. How much of this is really priced in is anyone's guess. A conservative assumption would be that most of this has been priced in and the reason for 2017's year-end stock run. I have mentioned many times about 2017's record low volatility. It's likely this low volatility environment is making investors feel a bit too complacent. That's unfortunate. While equities have had a strong propensity to rise each year, they rarely do so in a straight line as in 2017. 2017 was an outlier year, falling a total of just more than 27% cumulatively over the entire year. That's the lowest amount ever. As you can see in my next chart, on average, the S&P experiences a drawdown every year of about 10%. At this point, that would feel enormous, like it was the end of the bull market. Likely not though, just simply the norm. With a standard deviation of 5% in the data, a drawdown as big as 14% will still be considered within the normal range. As such, every investor should expect and be able to deal with something like this occurring in 2018 and every year. It's the normal ebb and flow of the markets. To summarize, based upon the above data, it's my take that U.S. stocks will likely rise in 2018. Earnings growth, investor sentiment, and valuation suggest that a mid-single-digit appreciation is a reasonable expectation. But the truth is, wildcards, especially investor psychology, could push returns much higher or lower. A bear market is possible, but unlikely, as they usually begin within recessions, and that's just not visible on the short or intermediate term timeframes right now. An intra-year drawdown of 10% or even much greater is odds on. That's the end of my story, and I'm sticking to it. Well, sort of. As Peter Brandt says, I have strong opinions held very loosely. Why? Because the key with investing is to always keep an open mind and keep every option available. If we love something in 2017, that doesn't mean we can't hate it in 2018. Just because we've been avoiding something in 2017 doesn't mean we can't be buyers over the next coming quarters. We're not here to be right because the market is the only one that's right. We're only here to make money. Before closing, I want to wish everyone a happy and very prosperous 2018. Until next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with December 2017's Charts on the Move.